Welcome back. This is the King's Crowd Investment Roundtable. Each week, we go into some of the latest news and happenings in the online private market industry, and we will do a deep dive into some of our data, whether that's a deal analysis or looking at our chart of the week. This week, we have two great topics on the docket. First, we're going to be talking with Scott Kitun about a just hot off the press launch of Hamilton Lane partnering with Republic and being able to give us access, us being retail investors, to a new private equity fund. Then we're going to be talking with our senior investment associates, Teddy Lyons and Léa Bouhelier-Gautreau, where we will go into the chart of the week this week for Women's History Month and taking a look at women-founded startups. Let's kick off the first segment. Scott Kitun, welcome. As always, you bring a wealth of knowledge, and I know you've been putting a lot of hard work into this launch with Hamilton Lane and partnered with Republic. Tell us what's happening. What do we have going on?
Yeah, well, I don't know about the wealth part, but I bring something. As you guys know, I've spent the last 4 months, 5 months trying to bring this thing to fruition. But to be honest with you, like this moment for me, we'll see how it pans out. Like we'll talk about that, but like for me, this moment is more about like the last 5 years of work, because I think we've talked about this ad nauseum on this show, and I know you and I, Brian, have talked about this a bunch of times offline, and people who followed the Pitch Reviews newsletter back in the old day, like they definitely understand this. The reality is that we need, especially with this like concern around retirement and people not knowing where AI goes with jobs, and there's all kinds of different things, like we need to make more money. We need to have better performance. The problem with crowdfunding, which I am obviously, like yourself, a huge fan and early advocate of, is that it's a proposition that maybe doesn't fit retail that well, because you're asking for high risk, high reward. And that can solve for the handful that have had a big exit. Like obviously it does, but for the rest, it doesn't. And this entire time, many of the biggest funds have not really been that receptive to equity crowdfunding, to Reg A, to tokenization for that matter. They've sort of avoided it, like, well, I don't know why, but I would do that. I'm above it, blah, blah, blah. And the reality is that has changed. That sentiment has changed. We'll probably get into why that is in the end of this conversation. But what has basically happened here is it finally a very large publicly traded, almost $1 trillion under management and supervision firm has decided to make it possible for all of us to invest in a private fund. And this particular private fund announced today is Hamilton Lane's private infrastructure fund. And the initial investment amount minimum is only $500, which is the first time it's ever been like that. It's usually $10,000, $25,000, $250,000. And that is basically just an extension of their traditional investment vehicle that they just allow people to invest in individually, but it's still the same thing. This actually allows everyone to access a category that is, 2.8x over the next 3 or 4 years as projected, with all the advancements in AI and infrastructure, crypto, energy use, just all of this stuff. It's accumulation of just so much, and it's beaten as a sector, as a private asset, has beaten the public markets 19 out of the last 20 years. We're talking, 15 to 25% annual returns, interest rates, and it pays back. It's cash flowing. This is why pensions and rich people love private assets, particularly infrastructure assets, because they don't have the day-to-day volatility that we see in the stock market, and they still return exceptionally well. And so now, as of today, a retail investor can be a private equity investor, and there is no limit. You can come on there and put $5 million into it if you want and feel very secure about it, because it's going into the fund directly. It's not, a mirror or some other bullshit that doesn't actually return. You are getting the same 5% redemptions every quarter as everyone else in the fund, rich or poor.
So to be clear, does that mean anyone who invests even at the $500 level, you're going into the same fund as these institutions who are investing tens of millions, hundreds of millions of dollars potentially?
Yeah. And like to put it in the simplest form so that there's any questions, like first off, you can go to republic.com/HLPIF, which is the link for this, and obviously invest, but I would recommend more just like learning and emailing and getting on email so you can learn more about this. I don't feel like this isn't a one-time investment fund. This is an accumulation of wealth over time type of opportunity. But what Republic did in particular, and they partnered with BitGo and a former Technori alum, Ed Woodford from was SeedCX then. Now it is Zero Hash, Chicago-based startup, are partnering in this entire thing to allow any investor to basically hook up your account. You can pay in crypto if that's your deal. You can wire capital. Republic is the custodian. The money goes into Republic. Well, technically, BitGo's the custodian, but you know what I mean. You go into Republic. We will hold tranches that allow, basically, we'll say $20 to $30 million before we convert from your token to Hamilton Lane cash, and then it becomes, call it, I'm making this up, this is an official record, but like Republic SPV1. And that money goes directly into Hamilton Lane. And then let's just say that we did it today. Again, I'm making this number up for conversation piece. Let's say it's $12 or $13 per share. And then, 3 months from now, you invest and the fund has continued to progress and it's now $16 a share. You could invest again there. Tranche 2, SPV2 goes in to Hamilton Lane. And now your share price might be different than the first share price, but that money is going into single tranches and then delivered to Hamilton Lane so that effectively you are represented on blockchain as the guy who invested $500 versus the girl who invested $5,000, but your money is sitting in the actual fund exactly like everyone else. You have the same rights.
Awesome.
It's incredible.
Well, that sounds super interesting. Just the fact that things like this, offerings like this, are now becoming available to the everyday investor. I would love, if you're open to it, to just dig into a little bit of like the logistics and the actual what is the fund? Let's start there. What is the fund actually investing in? When we talk like a private equity fund, I think a lot of the people watching this are used to investing in startups and creating their own startup portfolio online. What does this look like?
Yeah, that's a great question. So the real piece here is like infrastructure fund. What is an infrastructure fund? I think that we talk a lot, or people hear you talk a lot about artificial intelligence, tokenization, crypto, energy usage, robotics, everything that is basically like the last, I don't even know, feels like the last year and a half has been nonstop. But what really it is hyperscale AI data centers. So Microsoft Azure, Google Cloud, anything that is, heavy compute data center. Many private firms, including, I believe, BlackRock just bought, was it GIP? It was a massive infrastructure firm about a year ago for this exact cause, hundreds of billions of dollars that they invested in, effectively owning the data centers that are powering all of our compute, which is going to exponentially go up as a result of everyone having AI on their phone. And if we do, in fact, hit a world where crypto and tokenization and everything is a real thing, like that just adds to the power consumption and the data usage of data. So what these funds look at, and like this one in particular, I can't go into every single deal, but there are fund to funds like KKR and Apollo. If you go find their circular, which again, I've said before, this fund is available on Republic, but you can go to hamiltonlane.com and find the fund. It's a public ticker. So like you'll see on there like ownership stake in Heathrow Airport. This is a fund that's invested in by like Harvard and Yale and every pension that you can think of. This is a massive, massive actively managed fund. So infrastructure, again, hyperscale data centers, critical energy pipelines, powering all of these different, technologies, logistics networks. We talk about where travel is and delivery of food and whether or not people are, driving autonomous vehicles. All of that is grid usage and infrastructure building. And that's what you're investing in. So I think, while I could probably go for an hour on all the different individual pieces, the thing that I think sells it the best or like makes you understand it the best is when you look at picking, any number of the top 10 semiconductor and AI adjacent publicly traded companies, many of them will just like continually to go up, the tide rises all boats theory, but that's not actually true. And some of them will have a story like the deep research or DeepSeek or whatever it was. And all of a sudden NVIDIA is like tanks, right? In this case, you're not having to make a single bet on a stock. You're betting on the market. You're betting on the entirety of the infrastructure needing to basically grow and be invested in over a long time to facilitate all of the demand that we talk about every single day. So I think if you had to pick any type of fund to launch such a thing for retail, I think this is it. It's a little more complicated because you have to explain all this shit to people. But the reality is This is the most like you will see it and use it every single day investment, and not like a pie in the sky, like wait till the robots take us to Mars, if that makes any sense.
Absolutely. Yeah, I think I mean, infrastructure is not only something that was probably off limits to most non-accredited, retail investors, but it's also something I personally just didn't think about. Like, did I know that
Right.
you could invest in things like, airports or the grid or these different things? So that's super, super interesting.
I mean, Brian, I want to throw one thing at you just because you said it. The invest in airports is something that I think is funny because I actually had a guy be like, why the hell would I want to invest in that? And my comment was basically literally 2 weeks ago, the president was holding the supersonic jet in his hand. And all of these people are talking about autonomous drone delivery and like basically solution robotics for the last mile. Can you think of a better investment than the logistics network that goes out of Heathrow Airport, London? It's a global transway. Like for better or worse, political stuff aside, BlackRock basically just bought the Panama Canal. Like this is what we're talking about. Like this is an automated facilitation of all of our Amazon orders, all of our, food and shit, like everything is run this way. And this is the, like, and this is not a sales pitch for this fund. Literally, this is just talking about infrastructure. We're like, I don't even want to know. My kids are 4 and 6. I don't even want to know what the world's going to look like when they're 20. And this is the beginning of it. All this stuff has to be built before any of that can happen. So I think it's a very interesting place to just learn, if not invest. Learn.
Super fascinating. Yeah, you always hear, if you were back in the 1900s and you tried to predict what it would look like in 50 years, or in the 1950s, if you tried to predict today what it looks like with the internet, and you just can't, the human mind, we cannot extrapolate that
Right.
far out. So, like, we can't even imagine what the world is going to look like, and never mind 50 years, like 20 years from now.
I'm at like 5 years. I'm already out there. I don't know what's going on. Obsolete.
So I think a lot of our investors are also pretty familiar with investing in private markets in general, perhaps. But could you tell us a little bit more just about like investing in a fund might be new? So how do you get paid? What are these redemptions? What are the risks, right, with something like this,
Yeah.
investing in an infrastructure fund?
Well, to start, I was the official first investment in this fund. I'm excited to say I was the guinea pig that we used to test all the links to make sure that this thing worked before we went live, which was covered by our friend and ironically my classmate at Medill, Shanali Bassick from Bloomberg, was the person who first announced this. Producer Sam has a connection as well. He went to Bucknell with Shanali, and then I went to Northwestern with her. So it's kind of a funny catch-all here. Um, it's really simple. You go on to Republic page, you look at it, you make sure this is what you want to invest in. This is not investment advice. Anyone listening to this, I'm not telling you to do jack shit. Just go learn. But you hook yourself up. You will literally use Stripe like you do for everything else. Connect to your bank account. If you have crypto, you can use crypto. All that matters is you have to have a bank account that can receive capital, receive money upon payment out. No different than any other investment you've made in startups on Republic. There is a wallet component of it for the future, but you will not interact with it. It is not something you need to worry about. It's not there's no second step. In fact, this sits in your portfolio right underneath your startup investments if you're familiar with Republic. You will go on, you will sign a couple of waivers that says basically that you're acknowledging custodian and all this kind of stuff, which is just to make sure that you are aware of like where the money basically trades over, how this will work. And this is still like the beginning of this, but just assuming that everything goes as planned. How it works is because the SPV is run basically by Republic, there's an option to vote similar to, in some cases, your meaningless vote on Robinhood, in some cases, a meaningful vote on Robinhood. You basically have the ability as a group to this auto vote. We decided we would like to, activate or enable our 5% redemption this quarter, or we would not. We'd like to have it just continue to roll. This is an evergreen fund, so all of the proceeds can, in fact, continue to roll. And when there would be technically payouts and dividends from cash flowing events, if the larger SPV, which would be managed represented by Republic, if they decided that we wanted to take redemption, then we can, and if we decide not to, then it continues onward. If upon a dividend or redemption, it will appear in your bank account just the exact same way as it would if you had bought into one of the startups on Republic or anything else and it got exited or some other scenario. There's no, you don't have to go find it. There's no crazy stuff like that. I think what is most exciting and also scary because it's too early to tell, is the fact that there is, because of the way this is set up as a tokenization event, there is the ability for in the future, and that this was designed very purposefully. It's intended to do this, but we will see, is to have your ability to actually exit your position on, say, the INX exchange in the future. Now, I say the future and I say maybe because there needs to be a secondary market. Like people have to actually want to buy it. Like I am sure today I could put my listing on the INX and call it a day. I don't know if anyone would buy it. I do believe we're heading into a world where there is public credit through Apollo, and there's, maybe in the future, hopefully they're listening to this show, Sequoia Evergreen wants to go work with us and list there, that people will basically look at it like they do public stocks. And we've all heard Vlad talk on Robinhood about wanting to have real world tokenized assets on Robinhood. I believe that the future, if it continues this way, it's probably inevitable. I just don't know the timeline. You will be trading on a share per share value. So the idea would be if I came in at $12 a share or $13 a share for this fund, and 2 years later it's trading at $19 or $21 a share, whatever the case may be, like I should be able to get that value out of it, and maybe it'll be a little lower. It depends on the market demand. But the concept here is that it's treated exactly like you invested in anything else. It is not some token wallet trick bag you got to figure out until you want to make it that way. If you want to pay in crypto, then it's you're going to get paid back in crypto, whatever the account attached. But essentially, that's the gist of this. The goal is to make this something that is more liquid than a traditional fund. But do keep in mind, private funds are not traditionally liquid. And while they do pay out dividends, it is not something that, other than the 5% quarterly redemption, that you should expect. Like I could put in 1,000 today and like get it out in a week. Like that's not how this works.
Yeah. So as with all private market investments, it is going to be more liquid. Granted, it sounds like the redemptions are at least an opportunity where you may be able to get your money out if you need it in the future. But what about on the return side? I think a lot of people, if you invest in the public markets, maybe you expect like 6 to 10% after, inflation and everything else. Maybe angel investors are hoping to get that like 15 to 25% IRR. What could people expect, understanding that we're not projecting the future here, but based on historical performance?
I'm not even going to quote you Hamilton Lane performance, which is, I will just say, on par and exceeding in some cases, depends on their fund. Again, you can just go to Hamilton Lane's website and look at all of their suite of infrastructure funds, and you'll get a gist of kind of their performance historically over the last 5 years. They've been operating in this space for 36 years or something like that. So like, we're not talking about some new group. But with that said, like, it's probably not a moonshot bet if you're looking to get like 100x out of this. Although with AI, I mean, honestly, I'm not saying that'll happen, but like I could see it being more outsized over the next 2 decades if you want to wait that long. So there's that. It doesn't have the same risk profile as most of the assets that we talk about every day here. It's not something that goes to zero. I'm not going to say you can't. I mean, anything could happen. But traditionally, I guess we would be probably living with the dinosaurs when that happens, because you'd be talking about knocking out like all of the world power grid. So I'm not sure what would have to happen globally for this to go to total zero. The risk profile is pretty low. The return profile for the market, not Hamilton Lane, has been basically 18 to 22%, depending on the type of fund and its focal point being infrastructure, which is pretty exceptional. So I think you could reasonably expect that on the low end, you're looking at like a beats public markets. I mean, the infrastructure as a whole is the top performing asset class over the last 5 years, just in general private. That's a fact. And in general, private has beaten public 19 out of 20 years. So I think it's a safe bet to say that this fund will likely beat the public performance over the same period of time. But I think there's an opportunity to be like a 20+% performer. That's a real thing. And I only say that I do have a lot of respect for Hamilton Lane folks, and I think they're smart. But I actually say that mostly because if you just look at the investments being made in AI and like the crazy conversations that Musk and these guys, who just obviously today announced another $1 billion raise for X, which is crazy, for X.AI, the amount of money they're spending to build their own power grids and data centers is just kind of a testament to like what this looks like. So risk profile is good. Returns are generally good. What I think I like best about this is if you have the liquidity, liquidity is not a major concern for you. You have the ability to have something that's highly uncorrelated and does not have nearly the volatility daily. that you see publicly.
So it's getting more diversification for some of those investors in their portfolio.
Absolutely.
All right, I think you made a great case for that. One last question: whenever I'm considering an investment opportunity, it's trying to assess, the people behind it and like their intents. Could you share if you have any
Yeah.
insights, like why is Hamilton Lane and Republic interested in partnering on this? What does this get for them? While it's unlocking something new for retail, but what do they get out of it?
Yeah, I mean, I think for Republic, it's pretty obvious, and I'm not speaking for Ken or Andrew at Republic here or representing them in any way. I'm just saying this as an investor in that company and someone who watches Republic closely. I feel like they've been on like a 2.5, 3 year track to like become the people's hedge fund. So like to them, they want to have a diversified asset class. PE is the newest lever for that, in alignment with their sports clubs and their entertainment and their arts and everything else they do. Sometimes it's a little blurry what their plan is, but I think when you meet with them and you talk about the tokenization investments they've made, it becomes a lot clearer that they're trying to create a place where you can invest in like everything. And they think they've recognized that it needs to be closer to institutional. So this is a huge win for them to land a publicly traded, 856 billion AUM private equity firm to launch the first fund of projected many if we're successful with this fund. So that's them. Hamilton Lane is interesting because like this is a market wide question. Again, I do not represent Hamilton Lane. I am not speaking for Hamilton Lane nor their CEO or misconstruing any of their comments they've made publicly. All I will say is that the co-CEO, Eric Hirsch, who was just on Bloomberg, his story was like, I got introduced to the concept of this when I found out that we couldn't issue returns to our own employees who are not partners. So if we could just create a tool that would enable all of their employees, which I think are like 800 plus or whatever globally, to be able to own in the funds, that would be a really cool opportunity for them. And then they started, going down that rabbit hole and came to the realization that many have, which is that like in order to do true retail and offer $500 and not 50,000 per person, well, Republic is like the most logical place because they have the full stack. So that's why they went down it. I think that set aside Hamilton Lane and set aside Republic, my honest opinion as to why this is becoming something that is widely talked about, obviously money, everyone loves a good grab of money. That's clearly the motivator. But for like, people have been rich a long time. For 10 years I've been talking about this and getting laughed out of every room. The Goldman Sachs team, when they did the Marcus card, got laughed at by all of Wall Street. Like, why are they playing with poor people? It's been kind of a crazy story. But then AI and the venture collapse and the LP money basically sitting in lieu. I think one of the big questions that all of these guys have, and I'm not talking about Hamilton, I'm talking about market large private equity guys, is are endowments and pensions going to be the honeypot that they've been for the last 50 years? If AI takes out a certain number of employees, and in particular a certain sector of type of employee, and if universities are competing with basically a chat bot and a YouTube channel, how can you charge a student 50, 40, 30, 80, $100,000? And I say 20,000 because like that just goes back to what 20 years ago. I don't think you could even get a kid to pay 20,000 for an education other than maybe a top 25 university that gets the nice badge and says I went to Yale.
Yeah.
Like that's a question. So if that's the case, endowments are going to be sold and universities are going to transform themselves into other things. If they're state run, they're probably going to be shut down. Maybe not. I'm not trying to like ring a bell. It's just I think that's what they see. So if you weren't totally sure that you're going to be able to keep raising from them, then you got to find another source of capital. And here we are in 2025. You've got like 6 trillion of retail capital sitting on the sidelines by people who look just like the two of us. They're basically 35 to 50 or 45. They make 250,000. They've got 500,000 to a million in investable liquid cash. They don't have as many kids. They don't own their own homes. Like there's money to be had. And at the same time, their parents are setting up the largest wealth, transformation in history. As they die off over the next 10 years, the 75 and ups are going to transfer somewhere around 8 to 10 trillion back down to the 45-year-olds who then become 55 at that point and basically looking to like cap off their retirement. So there's a shit ton of money and it's basically all unbanked because these are not high net worth. These are people they're wealthy in some cases, up to $3 to $10 million net worth. But like, that's not the ultra high net in the family office level. That's just like a rich guy on the street. I think that they recognize that there's a $10 trillion capital opportunity that happens to coincide with a concern about the long-term validity of endowment pension style. So that's why I personally think that the tide has turned on their interest.
Well, as an investor, speaking for the investors, I am hugely in support of this because, it makes complete sense that if we let anyone, I said this example before, but you can go to the casino and put your whole life's paycheck, right, every month or whatever on black, but we don't let a lot of people
And I
invest.
have.
We don't let people invest in private companies. So, like, just
Right.
democratizing this, it makes complete sense. Like, just the internet, so much has changed so fast since the SEC was established with the regulations that they're still playing catch up. And I think we are starting to get there. But
Right. 90% of companies across the globe that make $100 million in annual revenue or more are private. 90%. The public markets make up less than 10% of the total.
yeah,
And that's not even including assets and gold and houses and real estate shit. It's wild. And I think we're like, if we get away from all this stuff, the details, and you just talk about the fact that we are seeing the merging of private and public. And I think that's really the real story is just you're seeing the merger. NASDAQ is now what, 24/5? Like, so 24 hours, 5 days a week. Like everyone wants 24/7. You can't compete with when people can go trade crypto against China in the middle of the night. People have the appetite. So I think this is just a part of it.
yeah. Well, again, you gave us a link. Everyone can check it out. I do want to make sure, too, we give kind of all the proper disclosures, disclaimers, right? So, King's Crowd, we're not being compensated in any way. We're bringing this on the podcast here today because it's a new investment opportunity for retail investors that we think is just genuinely interesting to learn about. I will disclose that while I invest on Republic, I am also an investor in Republic, the platform. Scott, I don't know if you have any disclosures quick for yourself.
Yeah, I'm an investor in Republic. I am being paid by Republic to work on the product, but I am not being paid by Republic to sell the product or compensated in any way, resulting in the performance of this product. Why I am here to share with everyone is because I truly think that this isn't about this product. It is about private equity is now available to retail. That's the storyline.
That's awesome. Well, Scott, thanks for joining us today and sharing this with us. And I'm sure we'll be doing some follow up segments and keeping tabs just as it evolves and as new opportunities come out there.
Awesome. Thank you guys for having me.
All right, on to this week's Chart of the Week segment. We are going to be looking at, for Women's History Month, some data around women founders in equity crowdfunding. Now, this is something that has always been touted as one of the potential benefits of equity crowdfunding. It's both that democratization of access to capital to be able to fund more underserved, underrepresented groups and minorities, and also democratization on the investor side, giving more people the opportunity to invest. So, Léa, I'm going to pull up the chart, but you took a look at the funding gap for women-led startups. Why don't you tell us a little bit about some of the data that you were looking at and some of your takeaways?
Yes, there's two things that we actually look at in this chart. The first is what if the share of deals that actually has any woman founder? Because we can't really expect women founders to be raising more than the number of deals that they actually are represented in on equity crowdfunding. And so the purple chart, the one on the left at every year, is actually showing us a number that has been stable over the year that we are aware of. About 25%, I want to say on average, of deals have at least one woman founder. So in this category, we have both mixed gender deals and only women deals, which means that the rest of the deals, about 75% of the rest of the deals, are men only teams or solo men founders. And this is kind of a number that has been steady as we can see it. It's also pretty much in line with what is happening in the venture capital world. And we think that there are a couple of reasons for that. As you say, Brian, equity crowdfunding is supposed to democratize access to investments. And so we could hope to have more women funded companies to raise more than the numbers we currently see. But I do believe that there are roots in society, other kind of discrimination, other gap that make it a little bit harder for women to actually start companies and become founders. The first one is that we know that men account for about 79% of graduates in technology and engineering fields, which are for a lot of people kind of the starting point to starting technology high growth startup. We also know that women have less access to C-suite positions. Only about 29% of them, of C-suite positions, are held by women. And so that also tells us that there's kind of a glass ceiling which is both from a limitation in opportunity and sometimes just lower level of confidence about women among women in their ability to scale companies. And so kind of all of that makes that for the last couple of years, there only has been about 25% of deals that had women founder. So I don't think that kind of the cause here is really related to equity crowdfunding. But what is really interesting in this chart for me is the green bar. So the green bar, the right bar on every year, is showing us the share of funding that women-funded company actually receive every year. And when I did this chart, I will expect that, all right, if there's about 25% of founder deals, of women funded deals, they should get about 25% of the money. But we see that systematically every year, there's kind of a deal funding gap where women raise significantly less than the a share of deal that they represent. The kind of biggest gap was in 2021, where they raised 53% less money than the share of deal that they were representing. So to kind of understand that, we try to look deeper at the data. And what really hit me is that no, actually, absolutely zero woman funded company has been able to raise more than $5 million since the start of equity crowdfunding, while all men teams has been able to raise up to 75 million.
Yeah, I'm curious how many equity crowdfunding startups have actually raised over 5 million, because I know that's essentially maxing out a Reg CF, right? And then 75 million, I think there's been like under 2 like ever.
We can definitely pull that data. I want to say off the top of my head, I remember I ran some data from like around 2023 to 2024, and I think there were 17 maybe is that were maybe above like 4.5 million, because sometimes they go up to 5 million and then some of the commitments fall off, but like between that 4.5 to 5. But it's probably a small handful, right? Like a couple dozen that have raised up to that maximum limit. And again, that was only since 2021. Prior to that, the max limit was actually 1 million. And there were quite a few companies that used to raise up to the 1 million as well.
In 2021, so we have the largest gap, 53%. That's a year where we have 19 companies that raise over $5 million. And if you look at 2023, which is the year of the lowest gap at 19%, we only have 5 companies that raise over that $5 million threshold. And so when you run the numbers, if I kind of remove Reg A, because Reg A is really what allows founders to raise more than $5 million. When I remove Reg A, all of these red arrows that you see, they are divided by half. So 2021, the gap is only 25%. 2023, the gap is only around 10%. And so it's really Reg A that gives male founders monthly the ability to raise more money. I do feel when I look at these companies that you have kind of a lot of car companies, robotics company, just super hardware stuff where women are chronically underrepresented. And I'm wondering if these are the type of deals that for whatever reason, equity crowdfunding investors favor. And because they favor these deals where women are just less represented in the pool of potential founders, they just get less access to that capital. Teddy, also want to just correct you one quick thing on the VC. So you're right. There's the number that says that only 2 or 3% of VC money go to women is actually to all women founded startups. So either 1 woman or 2 women or 3 women, but no mixed gender. When it comes to mixed gender teams, the number that I saw were actually around 20%. So pretty much in line with equity crowdfunding.
So Léa, I'm curious, now that you've really taken a deep dive into this data, are you encouraged? Are we moving in the right direction, or do you think there's still a way to go compared to, especially when we're comparing it to venture capital, but also just versus what you would expect?
Well, my main takeaway from this, and this is personal, people may see it differently. I feel like this is just based on the type of companies that investors are attracted to. They're just attracted to the companies where women are kind of chronically underrepresented. And I don't know if equity crowdfunding can really do something towards that, because it's a difference that happens, at the moment where men and women choose what they're going to study in college and what is going to be their field. Now, what is encouraging to me is that we've seen very successful women-led deals raising millions of dollars. So it's not because they don't raise above 5 million that they cannot raise $1, $2, $3 million online. We have, even a couple solo women founder who has been raising close to $1 million as well in the last year. To me, that's pretty encouraging. It means there is money. They're able to get in the top 10%. I think there's maybe just kind of a gap in terms of what are the type of startup that they're starting, not wanting to fall into the cliche, but just really looking at the data. And I've seen women raising companies like the video game industry. Overplay, Orange Comet, they raise millions on equity crowdfunding platform. I've seen women starting companies in the robotics industry as well and do extremely well. So I do feel that there is a great space for women founders to raise money, whether they are solo founder, whether they are in a mixed gender team. And I'm pretty hopeful that they're going to be able to raise big amounts. Now I wait to see that one woman founder that's going to be able to raise, I don't know, 20, 30 millions online. I don't think that this is impossible, but I just need to see it happening on the data.
We've seen so many, not only amazing founders, in a mixed founder team, they're often the CEO. So like Healthcare Originals, App Deco, like some amazing women founders have done quite well on equity crowdfunding. And those are two King's Crowd Capital investments as well. So can't speak as much on this, but I am encouraged that we're starting to see more and more traction from women-led deals and having it be somewhat looking better than the VC space. It's a big goal of equity crowdfunding. So
great. Well, thank you, Léa, for taking a deep dive into this data. And obviously, this is something, we will continue to monitor year over year, watching these trends, including, all the different funding stats associated with that. So with that, let's wrap up for today. Thank you, everyone, for joining us. And head over to King's Crowd. Create your free account where you'll get access to all of these great data-driven tools and get on our weekly newsletter where you can get all of these data-driven insights directly to your inbox. Until next time, see you all back here later.